What we've been seeing in the stock market as of February the 10th of this year is the textbook definition of a great rotation. In other words, a shift in market leadership where the baton is being passed from the hyper growth artificial intelligence stars to the broader real economy sectors. Our chief equity strategist and economist John Blank is here now to help us understand this better. John, why has this been happening?
Well, Terry, we started out with ChatGPT in 2022, and we're now in 2026. So that's a bull market of 3.5 years for the AI trade. And it has gotten very long in the tooth and extremely high valuations. And its valuations are carried out across the AI space into the overall stock market. So any rotation to value from growth, and you see that in the S&P 500 value picking up and staying above its 200-day moving average, and the S&P 500 growth index staying below it, that people are going to rotate money into a safer place, and safer places, cheaper valuations, Terry.
Given that, have the tech stocks, especially the Mag 7, had their day in the sun?
We'll see. I mean, for example, Microsoft is already back to its 2024 levels, and this is the case for a lot of these stocks. Not NVIDIA. I think NVIDIA, the picks and shovels chip companies that are supplying the data centers with their equipment are still red hot, but the other ones, the downstream ones that are facing competition in their big core markets are certainly facing some pressure.
If I'm not mistaken, there's also a relationship here to the 10-year Treasury yield. What is that?
Well, basically, Terry, as we get at high deficits, the concern can be that the government has to pay more to keep people invested in paying for those bonds that they're issuing from that deficit. And the worry would be that, stocks always sell off when long-term interest rates go up. Recently they have gone back down towards 4%, but we can easily get the opposite to happen in a scare, and we can get to 5.5%, and that will tank stocks for sure across the board.
So as I understand it, this divergence between the S&P 500 value and growth indices relative to their 50-day moving average is a technical indicator. What is it indicating regarding the market?
Oh, it's indicating selling and buying by traders, Terry. I mean, people who are watching these, 50-day or 200-day moving averages at 6 months or 2 months of time. And when it gets above that, it means there's people who are willing to press forward to believing in prices going higher versus lower when it trades above those types of averages. So it speaks to the bullishness that's out there in the marketplace.
All right. So what is the bull case for this?
The bull case for this is that it's been long overdue in a crowded market where 7 stocks make up 30% of the S&P 500 for money to rotate into cheaper mid and small cap names and industrial names. And it's just way overdue and actually quite healthy to raise the breadth of bullishness in a market like this. So it should not be construed as a negative thing at this point, but more or less something that would be expected after a long run for a number of years in a trade that's gotten long in the tooth.
Is there a bear case?
The bear case is underneath that AI selling is super models of business that don't need to run with huge profit margins. And we're seeing this with cloud and then other groups of AI companies that are coming into the marketplace, or legal services for AI, or insurance services for AI, or banking services for AI, or marketing, or audio and video production. I mean, so this is the worry, is that it will automate and remove those profits from the market that are the tech stocks, particularly in the United States, have kept the United States stock market way above the rest of the world. And if that gets blown up, those profits blow up, the stocks will blow up too.
How long do you expect this market trend to remain in play?
That's the big question, Terry. I mean, there's such a bifurcation of belief on where the AI trade goes, and the market will continue like it is today. We're seeing some bounce in these AI names to have a bifurcated performance, where some people are believers in the story that software will just rotate into higher productivity areas and carry on and keep its margins, and others who think it'll be disintermediated. And I'm sure in the aggregate, both of those stories will be true. It will just be a matter of picking the right ones, picking and staying away from the wrong ones. And that's always a lot tougher than people think.
Published reports show the U.S. stock market currently underperforming global markets. How much of a concern is that?
I think it's, again, part of this rotation that they've been cheaper than the United States for many, many years. And finally, the policy chaos in the United States is convincing a lot of people to add a risk premium to U.S. stocks, which makes that already high multiple even higher in a risk-adjusted sense, and that's pushing people into the international stocks.
So, against this backdrop, what's the bottom line for investors?
The bottom line for investors is I think you need to take seriously the Great Rotation, as it's called, and I think, but don't get overdone with the idea of any theme, including this one. There'll be counter rotations and opportunities that are available. So it's going to be a more nuanced thing, and I think people should understand that, anytime you see something like this that's thematic, you got to, be a little careful because the growth is still there in the tech stocks.
3 value stocks you've been watching include Barclays, FedEx, and Tokyo Marine.
Yeah, let's talk Barclays, Terry. I got a crazy chart with share price of $8 a share in early 2024. It's $25 a share now. Still a 9 PE. Foreign banks, Terry, have been one of the strongest performers of the last year because of this international trade, which is pushing people into these really cheap bank stocks as a first resort. And Barclays leading the way. It's A for value, C for growth, and A for momentum, and a number 2 ranked short-term buy with an 8.8 forward PE, still low for a bank, and some great earnings surprise. Last earnings surprise was 9.5%. The last 4 were 11%. So you got to like Barclays, and you got to like this type of story, and this is giving you the bulls out there in these international stocks a lot of strength.
FedEx,
the craziest chart you're going to see, Terry. It's been stumbling around $250 a share for many, many years, but it's been on a restructuring campaign. And it just took off and not too long ago, 3-4 months ago. And now it's $380 a share. So I'm a seller of FedEx after this type of move that's so parabolic. P ratio, though, Terry, is about 21, which is high, but not that high. And next year's earnings are $21 a share, which is a lot of money for a company to be making. So, again, last EPS surprise was 18.4%, which probably explains the incredible blowout in the share price. And the last 4 surprises were 5.7. So they tripled their surprises last time to bet. I will point out they're reporting on the 19th of March, and that will be maybe a sell the news event for a stock like this.
And Tokyo Marine.
Tokyo Marine. This is based in Tokyo, and it is a Japanese company, of course. Non-life insurance, life insurance, and asset management, Terry. So it's a conglomerate, financial conglomerate. And again, you could have bought this in 2024 at $25 a share, and it's now $41 a share. It used to be $45 a share. So P ratio of 10. Another one of these international stocks that's on fire, and it's because you got a decent story for both asset valuations. They're cheap. The stocks are cheap, and there's still earnings estimates that are going up.
Our chief equity strategist and economist, John Blank, on the Great Rotation. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.